Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for Kiesel, Weingart, and Warfield. This is problem 22-7. This textbook's authors are Don Kiesel, Jerry Weingart, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. So let's go through and have some fun. Okay, so we're right now over here. We are dealing with some error corrections. So we have over here, you've been assigned to examine the financial statements of Zarl Company. Whoa, that sounds like a character from the Planet of the Apes. For the year ended December 31st, 2020, you discover the following situations. Is that Jim Tanning and Laundry? Is that Mike Sorrentino? I don't know. We'll see. Right over here, depreciation of $3,200 on 2020 for depreciation of $3,200 on for 2020 on delivery vehicles was not recorded. Okay, so we're going to go ahead and do 12/31/20. And we're going to go ahead and record this. Now, there's no income statement that we have to go through and do. Rather, we're just going through and making entries. Okay, so we're going to have depreciation expense, delivery, accumulated depreciation, delivery trucks. And the reason why I'm kind of specifying this as delivery, because this would actually, believe it or not, be a sale, like a selling expense. So that's where this would more than likely be classified because it relates to delivery vehicles. So this would be 3,200 and 3,200. And then to record depreciation expense. Okay, I'm going to come back to number 2 at the very end. So let's just go ahead and skip that for the moment. A collection of $5,600 on account from a customer was received on December 31st, 2020, and not recorded until January 2nd. So if we got the money on 12/31/20, I'm going to debit cash. I'm going to credit accounts receivable. Now, more than likely, I would also have to go through and make, I would have to reverse out that entry on January 2nd. But if I got the money on December 31st, that's when I would want to go through and record it. Okay. In 2020, the company sold for $3,700 fully depreciated equipment that originally cost $25,000. The company credited the proceeds from the sale to the equipment account. Okay, let's go through and unpack this. If the equipment was fully depreciated, there was no salvage value. I'm assuming that what happened here is that the company said, oh, just give me a second. Happened is the company got cash of $3,700, and then it basically credited the proceeds directly to the equipment account. Now, if the equipment was fully depreciated and there was no salvage value, okay, so let's kind of think about this. So what happens over here is I have equipment, and this is going to be pre-adjustment. Basically, this is what I have. Now, when I sell equipment, what I need to do is the following, right? So over here, this is going to be 12/31/20. I'm going to have to debit accumulated depreciation on equipment because I got to take that off of the books. But at the impact of this journal entry here, if I credited the proceeds to equipment, I'm going to still need to take that equipment off of my books for $3,700. Now, in terms, $21,300. And so my balancing entry here is going to be a gain on sale of equipment. And if we think about it, the normal entry that I have you do for these types of transactions is what? And this should be now by this time, it should be loss balancing, cash, accumulated depreciation, equipment, gain balancing. So over here, that what I should have done is I got 3,700. I debited accumulated depreciation on equipment. I credited equipment. And then my gain is going to be my balancing entry. So that's what we're trying to go through and achieve by making this correction. Okay, that's number 3. Okay, number 5, a company filed a patent infringement lawsuit against Zarl claiming damages of $220,000. The company's legal counsel indicated, this is very important, that an unfavorable verdict is probable and a reasonable estimate of the court's award to the competitor is $125,000. Okay, now remember, when we have a lawsuit, right, the key words we're looking for, is it probable? Not is it a possibility, but it's got to be probable, and we got to be able to reasonably estimate the amount. The other thing that I would also be doing too is I would want to make sure that the company's legal counsel can basically communicate with the company's outside counsel to essentially ensure that this amount of the damage is appropriate. And the reason is because when the auditors are going to be out at the client, they're going to be doing, you always make inquiries with all the attorneys. Why do we go through and make inquiries with the attorneys? Because we need to see if we need to accrue anything else on our financial statements. So right over here, what I'm going to do for number 5 is I'm going to go ahead on 12/31/20. I'll call this over here lawsuit expense. I could also say over here patent infringement. And I'm going to go ahead and credit accrued liabilities and to record lawsuit accrual. So I just call it to record lawsuit accrual. So this over here, I'm going to put this as 125,000, 125,000. Whenever I disclose a lawsuit that is happening on the financial statements, I have to be extremely careful about how I go through and do it. Why? Whatever I write in the financial statements is fully discoverable, right? So if you are putting something in the financial statements, you want to follow by what are the rules of disclosure. So we want to be really careful about how we go through and phrase it. Remember, this is not Depp versus Heard. We don't need to get into all the crazy stuff that goes on in the courtroom and we don't need to go any further, but that's what we need to go through and to do. Okay, so let's go ahead and look at number 6. Zarl has a portfolio of trading investments. No entry has been made to adjust to market information on the cost and fair value is as follows. So right over here, we've got a cost and fair value, which were the same in 2019. However, so there was no allowance necessary. Remember, we have to record securities at their fair value. So what we're going to go ahead and do over here is, well, what is the cost? The cost is 84, but the fair value is 2. So what I'm going to need over here is I'm going to need an adjustment to investments, or fair value adjustment. This is a asset account. Could be an asset or contra asset. This is going to be here for 2,000. And this is going to be an unrealized holding loss on securities. Okay, so this one over here, this is going to be going through when we have an unrealized holding loss. If you look at Apple, right, Apple has a lot of securities that they're holding. And as they're going through and holding those securities, what happens? Well, what Apple needs to go through and do. So what Apple needs to do is right over here is if we see Apple has a lot of investments. In fact, they have $141 billion of marketable securities, and that was as of March 26th. So if we look over here, what you'll see as well, we have to show the change in fair value, even if we're not selling anything, right? So I would credit marketable securities or debit marketable securities, depending on what would be happening. But then what we saw there is that unrealized holding loss. This is going to be something that's going to be included in other comprehensive income. It's not net income because we didn't make the sale, but it's going to be in other comprehensive income. Okay. And this down here is when we look at the statement of retained earnings, like how does this all balance out? It's going to come down over here and it's a component of shareholders' equity. We're also going to put in foreign currency translations in there. So there's a lot of stuff that's kind of random that goes in there. And this over here is to record securities at fair value. Okay, let's go ahead and take a look at number 7. Number 7, an analysis of payroll information shows accrued salaries of $12,200. The salaries and wages payable had a balance of $16,000, which was unchanged from the prior year. So my salaries and wages payable, right? So my salaries and wages payable had a balance over here of 16,000, right? So this is the balance pre-adjustment. Now, what it tells me here is that my accrued salaries and wages should be 12,200. Okay, so what do I need to do to balance? Well, if I subtract this from here, I'm going to get a balance here of 3,800. So what I'm going to need to do is I'm going to need to debit salaries and wages payable. And then I'm going to credit salaries and wages expense. So because I'm going to go through and accrue the proper amount. Now, if the books have been closed, I might have to do something with retained earnings, but that's really not the case over here because the books are still open. Okay, so because the liability was at 16,000, but the liability should only be at 12,200. This is how we would go through and record liabilities or with credits. So, but when in this particular case here, I have to reduce my liability. So I'm going to reduce my salaries and wages expense. Okay, right over here, number 8. A large piece of equipment was purchased on January 3rd, 2020 for $40,000, was charged to maintenance and repairs. The equipment is estimated to have a service life of 8 years and no residual value. So right over here, what do we go through and do? So the first thing we're going to need to do is we got to get that equipment out of repairs and maintenance. Remember, if it's going to be repairs and maintenance, it has to be something that's ongoing. If we're buying something new, that's different. So over here, what we're going to do is we're going to debit equipment for $40,000. And we're going to credit repairs and maintenance expense for $40,000. And this will do this on 12/31/20. Now, in addition to this, I also have to depreciate the equipment. So I owned it for the full year. So my depreciation expense, and I'm going to credit accumulated depreciation on equipment. This is going to be 40,000 divided by 8, straight line. So you're going to get here 5,000 and 5,000. Okay, so over here, to reclassify equipment and record depreciation expense. Okay, number 9, and this one actually messed me up when I was going through and doing it. So we're going to take a little bit of time to make sure that we're getting this right. So right over here, when I have the insurance expense. Okay, so right over here. Give ourselves some room. Okay. So a $12,000 insurance premium that was paid in the prior year or on July 1st, 2019 was charged to insurance expense. Okay, so right over here, a $12,000 amount was charged to an insurance expense. Now, what we have to be careful about this one is that this is actually a 3-year insurance policy, or 7/1/19 to 6/30/20, 7/1/20 to 6/30/21, and then 7/1/21 to 6/30/22. Now, I have never seen a 3-year policy unless it's something called a tail. And that's not like tails of years gone by, but that's basically if someone cancels the policy or if we go out of business, we buy a tail just to make sure if there's any lawsuits, our coverage is extended for those acts. So over here, the $12,000 insurance premium, this is really for 3 years worth of coverage, or this total of $12,000. Now, when I look at this over here for 2020, my insurance expense, right? Because what's going to happen with this insurance expense is going to be closed out to retained earnings. So my actual amount of my insurance expense, because I have to show what I use for 2020, is going to be a full year, or basically 1/1/20 through 12/31/20. It's 4,000 because it's 6 months of this policy and 6 months of this, or 2,000 and 2,000. Now, what is the amount of my prepaid insurance? Well, my prepaid insurance, and this is again is going to be as of 12/31/20, should be how much? Well, over here, I've got 2,000 left on this policy because this is going out through 2021. Over here, I've got 4,000 on this policy. So this is going to be over here a total of 6,000. Okay, now if we go over here, and these are the balances in terms of what I should have had. So if I'm looking at this, what I want to go through and do is say, okay, right over here on 12/31/20, I know that I have to have insurance expense because I have to show what I used during the period. This is going to be for 4,000. I also know that I'm going to have over here, I'm going to have prepaid insurance because this is the value as of December 31st, 2020 that was correct. Now, what happened to this at the end of last year? Well, as we know, insurance expense, my revenues, expenses, and dividends are all closed out to retained earnings. So over here, I would have debited retained earnings. I would have credited insurance expense for 12,000. Well, guess what? That was way too much to go through and close because the actual amount I should have only closed out would have been 2,000 because that's what we went through and used. So if I look at my entry over here, my retained earnings is actually going to be adjusted for 10,000 because that's basically the difference between this is what should have happened and this is actually what did happen. So when I look at what should have happened and what did happen of 12,000 and 12,000, this net amount is basically a retained earnings of 10. That's what I'm using over here to correct it. So remember, whenever you're doing an entry like this, the approach I would take is I would say, okay, at December 31st, how much do I have left? Right over here, I've got 6,000 worth of insurance left. My assets have to reflect their future economic benefit. Also, my expenses have to reflect what we have used. So again, that's how we would go through and show this to properly record insurance expense and prepaid insurance. So that's what I would do for number 9. Okay, a trademark was acquired at the beginning of 2019 for 50,000. No amortization has been recorded since its acquisition. The maximum allowable amortization period is 10 years. When I have a patent or a trademark, the rule is I have to amortize it over the lesser of the useful life and the economic life. Excuse me, legal life, useful life and the legal life. Oh, almost lost that one. So let's kind of think about this right over here. So When I'm going through and doing this as of 12/31/20, I know that I'm going to have to take amortization expense, and I'm going to have to take amortization expense of 50,000 divided by 10. And this is going to be amortization expense for 2020, or the trademark cost, useful life, or this is going to give me 5,000 per year. Okay. But now, okay, the challenge here is that, well, this isn't exactly correct because I've only shown 1 year. I can't show the expense from 2019 onto this part over here. So what I'm going to do is I'm going to go ahead and debit retained earnings. And this is essentially for the 2019 amortization. So this would more than likely be a prior period adjustment. Now, in terms of the credit side of this, I have two options. I can directly credit the trademark, or a better one I like to use is accumulated amortization for that trademark. And over here, I would show this as a 10. Now, if we look at this, the trademark will now have a value. It had a value of 50 less my accumulated amortization. This over here would be at 10,000 credit. So my trademark net is going to be at 40,000. So that's how we go through and record amortization expense. Okay. So going back over here to our first one, or number 2, this has kind of stumped me at first. So let's kind of read this through together. This is going to be at 12/31/20. So the physical inventory count on December 31st, 2019 improperly excluded merchandise costing 19,000 that had been temporarily stored in a public warehouse. Zarl issues a periodic system. Okay, so when you look at this, this was inventory that was there that had been excluded. So essentially what's happening is I'm looking at 2020, well, all my stuff is there, but I had excluded 19,000. So I'm going to make an assumption that because it's not in my physical inventory count, it must have been sold. So what I'm going to do with this 19,000 is I'm going to debit cost of goods sold for 19,000. Because it would have been my ending inventory, and this is what it's going to. And then over here, I would be crediting retained earnings for that 19,000. Now, because it's not telling us more information, I'm just going to dump it to retained earnings, or the current year, basically, because that amount should have been gone through and have been recorded as inventory. But it was sold, it was gone by this year. So therefore I have to put it into cost of goods sold. And if you're in my class, I'm not going to give you that question. I have plenty more questions to give you to fully confuse you and make you have even more fun with intermediate accounting. So we'll call this record cost of goods sold from inventory counted on 12/31/19 that no longer existed in 2020, hence cost of goods sold. Okay. Edit, delete values. Okay. All right, so those are our different journal entries for this one. This is actually kind of a fun, or at least it was fun for me. I'm not sure how it was for you guys, but it was fun for me because it's kind of a review of a lot of the different chapters. So, but in any event, I want to thank you. And I also want to thank Wiley for allowing me to use these video solutions. So please don't forget to like and subscribe. Other solutions, please feel free to ask for them in the comments. I look forward to seeing you on the next video.